On August 5, 2024, Japan's Nikkei dropped 12.4%, its worst single-day loss since Black Monday in 1987. The CBOE Volatility Index surged to 65.73, the largest single-day spike in its history. In 4 hours, $1 trillion in technology market capitalization was erased from global markets. The immediate triggers were macroeconomic, a surprise 0.25% rate hike by the Bank of Japan, a weak employment report activating the SOM rule recession indicator. But the magnitude of the sell-off was not. Between 60 and 70% of global trades now execute algorithmically. These systems are probabilistic wrappers, engines of statistical likelihood, with no deterministic understanding of market microstructure. The crash was not a market failure. It was a systems architecture failure. Consider how a naive retrieval-augmented generation system failed during this event. These tools split market reports into chunks and retrieve what is statistically similar. The result: temporal blindness. A 2010 housing crash looks identical to a 2024 liquidity warning. Context vanishes. A Bank of Japan decision in July and a fund's margin call in August are processed as separate, unrelated events. Multi-hop reasoning collapses entirely. And critically, the volatility index itself was a lie. In pre-market hours, market makers widened bid-ask spreads to manage uncertain books, mechanically inflating the index by 180%. Thousands of automated systems fired sell orders on a signal that was a technical artifact, not realized market volatility. No probabilistic system caught it. The architecture that should have caught this is the Neuro-Symbolic sandwich, a 4-pillar stack that separates dialogue flavor from immutable business logic. The first pillar is the symbolic constraint engine. Market mechanics and regulatory requirements are encoded in a legal domain-specific language. Hard rules that no prompt can override. An agent cannot recommend a trade that violates margin requirements regardless of input. The constraint is the floor, not a guardrail. The second pillar is the knowledge graph. Rather than brittle vector embeddings, economic relationships are mapped explicitly. Currencies, institutions, statutes, and derivatives all as nodes and edges. When a Bank of Japan rate decision enters the graph, the system traces its connections: carry trade exposure, yen-dollar correlation, technology equity concentration, before generating any signal. Multi-hop reasoning becomes structural. The third pillar is the finite state machine paired with utility AI. For execution, the agent follows deterministic logic paths. Every action is audited against a value function. The cascading feedback loops of August 5th are structurally impossible. The fourth pillar is token masking with JSON schema compliance. AI outputs are not text to be interpreted downstream. They are structured, validated code that bank ledger systems parse without error. Layered above this stack, a graph neural network models the market as topology. Nodes are assets: the Nikkei, the dollar-yen pair, NVIDIA. Edges carry correlation intensity, updated through message passing. When yen volatility enters the graph, the model traces its contagion pathway to U.S. technology holdings before the first sell order fires. The evidence is in the August 5th data itself. The volatility index anomaly preceded the crash by hours. Pre-market, the index rose 180%, not from realized volatility, but from the mechanical widening of bid-ask spreads as market makers managed uncertain books. Every algorithmic system treating that signal as ground truth fired sell orders on a ghost. A deterministic symbolic layer would have identified the spread widening mechanism before a single order executed. The contagion was topological. Japanese foreign portfolio investors held 2.18 lakh crore rupees in Indian equities. When the yen strengthened 7.7% in a single week, net outflows from Indian markets reached over 10,000 crore rupees on August 5th alone. A knowledge graph would have traced this pathway in advance. On volatility prediction, graph neural networks achieve a mean square error of 0.0025 and a root mean square error of 0.05. significantly outperforming recurrent and transformer architectures. The advantage is structural. GNNs capture multi-hop interaction, relationships across the full network topology of global markets. That is precisely the reasoning pathway that failed on August 5th. The $1 trillion wipeout in technology valuations was not a black swan. It was a known failure mode executing at scale. When probabilistic algorithms control multi-trillion-dollar markets without a symbolic anchor, volatility is not an edge case. It is the design outcome. The NIST AI risk management framework defines 4 enterprise functions: govern, map, measure, and manage. The manage layer, implemented as a financial safety firewall, is a deterministic monitor model. When it detects a SOM rule threshold breach or a quote-based volatility index anomaly, it severs the generative engine. The automation of danger is met with the automation of safety. The AI gold rush has ended. The era of engineering begins. Veriprajna has documented the full architecture, the Neuro-Symbolic stack, the knowledge graph topology, and the governance framework in a 14-page technical brief. Read it. Approximately 18 minutes. The next market shock will not wait.